Okay, class. Yeah, just waiting for a few more people to join the class. Um, you can see a course in you can join. I don't know why. So you're welcome to another class, and we want to start group account today, and we hope to finish it in 4 periods. We'll just try as much as we can. And if you're able to finish it, then this will then be like a foundation for the SBL student, for them to then move to um, the more relevant ones to them. But this very one will serve as a foundation to ride on. While for FR, financial reporting, it's a part of your syllabus that is around 20%, and it comes out every diet as an optional question in question B for 20 marks. So if it's something worth knowing because it's going to expand your choice in the exam. So we're going to start the journey in a few minutes. But before then, I remember very well that last week we looked at impairment of asset, and I remember that I gave you assignments to look at, and quite a number of you did not submit, which is not so good. But the standard itself is very straightforward, as the objective is just to ensure that we do not overstate our assets. We want your, and when I say asset, I was able to narrow it down for you last week that they are majorly non-financial assets, and I gave you some examples. And I also identify the assets that are not covered by the standard. So the aim is to ensure that you don't overstate your assets by ensuring that your assets in your books as PP or intangible assets are never above and beyond their recoverable amount. And their recoverable amount is the higher between how much you can recover from selling the assets, which we call net realizable value or fair value less cost to sell, and how much you can recover from continue to use the asset, which we call value in use. So the higher of those two is your recoverable amount. So this standard is here to ensure that your assets, PP and intangible assets, are never above and beyond that amount. Whenever this happens, we say the asset is impaired. One of my students asked me today, that was then the difference between revaluation deficits and impairments. They are the same in terms of accounting treatments. They are the same thing. But revaluation deficit is just a temporary loss. Loss in the value of an asset is temporary in the sense that it can reverse. It can reverse, meaning that loss can become a surplus in few months or in few weeks. It's very temporary. However, impairment loss is a permanent loss in the sense that we don't expect it to reverse. And that is evident in the indicators of impairment. When you look at the indicators that I mentioned, like the external indicators, like when there's a decline in market value, general market value, or when there is a change in economic or technological markets, legal environments, interest rate, market capitalization. And when you look at the internal indicators, we're talking about physical obsolescence or damage. or there was an accident. It's more permanent. When there's a decline in productive performance, when there is an adverse change in the use of the asset, all of this can bring about a serious loss in the asset that is more permanent than mere changes in value that's temporary. So that's really much of it around impairment loss. Then we identified a, a gap in reality that you said you want to ensure that your asset is not above its recoverable amount. But there are a lot of assets whose recoverable amount cannot be determined. That's specifically value in use. Yes, you can determine net realizable value of most assets, but to determine their value in use is difficult because they don't generate money on their own. Because they don't generate money on their own. Because of that, we cannot determine their value in use. Then how do we then impair such assets? Then the practical solution is cash generating units, where you would need to put together, you will need to consider a lot of assets together. Instead of looking at that asset in isolation, why don't you look at a whole lot of assets that makes money together so that you can be able to get their cash generating unit since they make money together. And practical examples are if you're speaking to a company that runs a factory, then you should be looking at the whole factory as a CGU. So all the assets in that factory will be put together to make up the CGU, or a supermarket. Then all the assets in that supermarket will be put together to make up a CGU. But the whole idea is that we want to determine our value in use. Now, when we're able to determine that, then we can determine the recoverable amount. Then we can determine the impairment loss. Now, when we then determine the impairment loss, considering the fact that we have put together a lot of assets to make up these assets, to make up this CGU. There are more than one asset there. Then how do we then treat this impairment loss? We need to then share it or allocate it to the individual assets in the CGU. And I-16 specify this order. It says first, you allocate to physically damaged assets, then to goodwill, then to other assets on a pro rata basis. And this order is strictly important that we have to adhere to it in all our solutions, in all our explanations. They want you to adhere to this order. And I mentioned that when you're allocating impairment loss to CGU, to assets in a CGU, I said you must not reduce any of the asset below its net realizable value. This is very important. In fact, this sentence is the very basis of that first assignment I gave you. The solution is based on this sentence. When you are allocating impairment loss to assets in a CGU, you must never reduce any of those assets below its net realizable value. Otherwise, you would be understating the assets in that case. You'll be understating the assets because the aim is to ensure that you get to its recoverable amount, which is the higher of net realizable value and value in use. So when you're allocating impairment loss to assets in a CGU, you need to watch out for this. Additionally, I said where assets, financial assets like receivables are within the CGU, I say you should not allocate impairment loss to them unless that asset is the specific reason for the impairment loss, is the cause of the impairment loss. And they will tell you in the exam if it is the cause. Unless that is stated, you do not allocate impairment loss to any of these items because they have their own ways of determining impairment loss, which is different from how we are doing it under IAS 36. Even though impairment loss is a permanent loss in the value of an asset, it's possible for it to be reversed. The impairment loss can be reversed. And this would happen where there is a reversal in the indicators, where there are positive indicators of impairment. And also, before you can reverse, you must ensure that the new value is not higher than the original value before the impairment. Then really, that was most of the explanations I did last week. Then we saw a question on allocation. Now, I want to show you the solution to the assignment I gave you because it's very important. I really need you to know it, even though it's saddening that most of you did not reach out in regards to your submission. And you'll be missing out on a lot as the exam is approaching. That is not how to prepare for an ICAN exam. That's the very wrong way. So let's get it together and do assignments. Okay, Laura, I think you have a question.
Yes, sorry, good afternoon, sir. So I want to ask, in case you're told that the current asset is the financial asset is the reason for the impairment, how do you allocate the impairment loss? Is it the full amount or proportional basis?
It depends really. It depends really. So you would usually consider it almost first because when the examiner tells you, they will tell you that it's usually the cost. When a financial asset impairs, it's mostly impaired to zero. It's just like a trade receivable. When you have a trade receivable that you cannot collect the money again, you will impair it to zero. It's to zero. Or the examiner specifically tells you the limits you should stop. The limit you should stop is if it's the reason you impair it to zero, or they tell you the limit you should stop. Because financial asset is very fragile. It's financial. So when it's lost, it's totally lost. There's really nothing you can do about that. So good question, Laura. Okay. Now, this assignment I gave you was a 2021 question, and it talks about a company, okay, that bought a government asset. So because the government is trying to privatize and commercialize some sectors in the country, so the Ministry of Transport sold the asset and liabilities of a newly constructed standard gauge railway to a private company known as Stalos to ensure smooth operation of the railway. So the government sold a railway station to this company, Stalos. We're given the summarized extract of the statement of financial position at fair value of this company on January 1st, 2019, reflecting the terms and conditions of the sales agreement of the Transport Ministry as follows. So this is the asset and liabilities, majorly asset I can see here, of SRL, majorly the asset of the railway that was sold to SRL. So apparently, SRL paid 2.2 million. Of course, that's around 2.2 billion. It's no more than that. So Let me just focus on this figure and be writing this as a level of rounding off. So 2.2 million. And it comprises of all these assets. Of course, if you add all these assets together, it gives you this, right? So then the next paragraph tells me that the license, that is this, is a 10-year period, and it was issued on January 1st, 2019, right, by the Transport Ministry, and it is stated at cost. So this is stated at cost. This is the cost of the license. Also, I'm told that the carrying value of the property and rail tracks and coaches are based on value in use. So this property, rail tracks and coaches, these two are based on value in use. That means we can get value in use of these two items. Also, we're told that the engines are valued at their net selling prices. So they had two train engines, and it is valued at their net selling prices. So if you see that in an exam, I will immediately know that if it gets to a point where I have to impair these assets as a CGU together, I know that I cannot impair this train engine below this 750. I cannot impair it any further because it's already reflecting. It's recoverable. It's reflective of its recoverable amount. That's the net realizable value. Remember what I told you? That when you are allocating impairment loss to a CGU, you must ensure that you do not impair it below its net realizable value. So giving me this as the net realizable value of the engines, I'll remember that I cannot impair below this. I'll most likely leave it alone. Going forward, I was told that on February 1st, 2019, one of the train engines got damaged due to a technical fault from the manufacturer, and the engine was completely destroyed. So one of these engines has been damaged and destroyed. And also that the sale of the asset to SRL was without recourse to the Transport Ministry and the manufacturer of the engines, meaning that SRL cannot go back to the government and say that one of the engine is damaged. Can you take back your train engine, or can you take back your train station? I'm not buying again. Or can you help me repair it? No, it doesn't work that way. It's without recourse. You cannot go back and complain. It's yours, is yours. Go and sort it. Now, in view of this, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the old train station, train service business of SRL was assessed to 1.5. So because of this damage, now they have reassessed the estimated value in use of the old train service as this. From this, that's an impairment, obviously. The value of the old train station was this before, but because one of the engine got damaged, now the value is this. So we need to write down this value from this to this. We're also told that the number of passengers after one of the engines of the train got damaged was below expectation, even allowing for the reduced capacity. In the light of this, the value in use of SRL rail service was reassessed on March 31st, 2019 at 1,350. So there is a further reduction in the value in use from this to this on these dates. So there is a further impairment loss. We now said on these dates, that is March, the SRL Limited received an offer of 675 billion from another company called Papaya Rail Service for the operating license. meaning SRL is considering selling the operating license and the company brought an offer for 675. This information only tells us the net realizable value of this operating license as at that date. That means if for whatever reason we have to impair this operating license as at this date, we cannot impair it below this. We stop at this. Cannot go below its net realizable value. We're now told that the realizable value of other asset has not changed significantly. Required. Draft a memo addressed to the MD of Stalos, explaining the basis of allocating an impairment loss to the asset of a CGU in accordance with IAS 36 on impairment of asset. B, calculate the carrying amount of the asset of SRL as at February and March. C, explain two conditions that must exist before an impairment loss can be reversed. So let's draft a memo. When the examiner says draft a memo, you draft a memo. Don't just start writing, draft a memo for them. When the examiner says calculate, you calculate. Don't start explaining. When they say explain, you then explain. When they say discuss, discuss is even more detailed than explain. When they say discuss, discuss in the light of the information given in the scenario. Then you carry out some in-depth evaluation, some discussions that are relevant in context given in the question. So we always take this seriously. So since I was asked to write a memo, the name of the company, this is not necessary. You don't have to write memo, but if you wish, fine. From the accountant to the MD, then the subjects, the basis of allocating an impairment loss to the asset of a CGU. Dear sir. Supposed to put dates. Let me put dates. Let's do March. That's the dates of the question. Let's do March. Okay, so dear sir, just both subject matters refers. The above subject refers. I told them that CGU is the smallest identifiable group of assets for which independent cash flows can be generated. And I said allocation of impairment loss to CGU, number one. Any identified impairment loss on the specifically damaged assets should be used to reduce the carrying amount of that assets. The remaining impairment loss after the above treatment, if any, should be charged against goodwill. After goodwill has been reduced to nil, any other impairment loss remaining should be allocated and charged to non-monetary assets. I was very specific. Non-monetary assets. Okay. So, and I said that yes, monetary assets such as trade receivables should not be exempted from allocation. And what I mean here is that if they are the reason for the impairment loss, if it is mentioned, they will tell you about them, that they have been impaired. If they don't tell you and tell you that they have been impaired, don't allocate to them. Don't allocate to them. Then, I now mentioned that the carrying amount of any asset in the CGU should not be reduced below the higher of this, the highest of this. Don't reduce it below. The point is that don't reduce it below the recoverable amount or zero. That's the point here. So that's solution A. Then I signed off. Now B, where they asked us to allocate impairment loss in February and in March. First, I listed out all the assets given in the question with their carrying amount. The total was 2.2. So what we just did was to list out these assets, all of this. Then I followed the order of impairment loss So the order is that I first allocate to physically damaged assets. And from the question in February, because they segmented the question into February and March. So this paragraph deals with February, while the subsequent paragraphs deals with March. So they want me to calculate the impairment loss first in February, considering the fact that the value in use is now this amount. So I'm writing it down from 2.2 to 1.5. So first, I allocate to the physically damaged asset, which is one of the twin engines got damaged. And since we have two, and the value of the two is 750, so the value of one will be half of that, half, which is 375. So half, which is one of the twin engine, is damaged. You need to impair that fully. Is damaged. Impair it fully. Is damaged. So, and that is why my first line of impairment loss is this twin engine, and that is why I allocated 375 to it. So remaining one twin engine. Now, after damaged assets has been taken care of, the next item that would be impaired is goodwill. And my goodwill is 150. I allocate to it fully. And I can conveniently say fully because I know that my impairment loss is this 2.2 minus the 1.5. I know it's 750. You might want to calculate that so to have it in mind so that you'll not be impairing beyond the impairment loss that you have. So I've really done 375. I still have a lot, like another 375. Then 150 fully. I take out the goodwill, everything. And the thing about goodwill, if you have not mentioned this before, is that immediately you impair goodwill. That's the end. They can't reverse. Goodwill can, if every other item is reversing, even this one that got damaged, they can repair it and it comes back to life. Then we upgrade the value. But goodwill, there's no repairing for it. Immediately you spoil your name as a business or as an individual, it's gone. That name is spoiled forever. It's always part of you. Nobody would forget. Now, after you have allocated to that, every other asset, you then impair them on a pro rata basis, on a proportionate basis. So we have taken out 375 and 150 out of the 750 impairment loss we have. What's the remaining? Who can tell me what will be the remaining impairment loss to share among the remaining assets?
600.
No, we have
1,350.
no. Out of 750, we allocated to 375 and 150. What's remaining?
25.
Correct. 225. So it's remaining 225,000. So that 225,000, we need to then share it amongst these assets based on their carrying amount value, based on their value. So we need to share it among this, this, and this. Yeah, David, I can see your hand.
Yes, sir. Good afternoon, sir.
Hi,
Please, I want
David.
to ask, in reality, would a company want to impair their goodwill in their books if there's a general impairment like this?
Say it again. Say it again.
I said, in reality, would a company want to impair their goodwill in their books like this when
No,
there's
they
a
will not.
general goodwill, or can they just keep it and impair other assets?
No, they will not. They will not. So, in reality, is that you will not even find goodwill in the books of any company. Okay, I'm going to teach you group accounts today. So, goodwill is only found in a consolidated account. Is not recognized in individual companies' account. And usually is the auditors that does most of these adjustments. The auditor is supposed to look at your assets, your liabilities, income, and ensures that it shows a true and fair view. If there are situations where they see that it's not showing, they pass audit journal or they recommend audit journal, and they give you a management letter to ensure that all are executed, and they tell you internal control weaknesses. So will they willingly want to do that? Of course, no. But when the auditor comes and see that your image has been doused, the indicators of impairment shows that the level of impairment loss you have is over and above any physically damaged assets. The next line of assets they will impair is your goodwill. And it's not in individual company's account, it's in a consolidated account. Good question. So, as I was explaining, the remaining 225,000 will be shared among these three assets. You see, I'm excluding one asset, which is the remaining one train engine. It's only one train engine that is damaged. So, and I said the remaining 225 will be shared among these three assets. Who can tell me why I'm not going to impair the remaining one train engine further? Who can tell me that?
You told us in the question that the value there represents its fair value.
Okay, continue. I can't hear you again.
They told us in the question that the other train engine represents its true fair value or something in that manner. So we are not supposed to impair it since nothing like there was no fall in value in that other train engine.
Okay, good. That's absolutely correct. So when they give you net realizable value, you do not impair below that. Don't impair below. The only reason we have to impair one of these train engines is because it got damaged. The second one, we don't touch it. That's its realistic value already. That's where we want to be. Okay? And that's the reason I'm not touching it. So I showed you the workings here to impair the other ones. The operating license, the property stations, the road tracks. For the license, I just did 900 all upon the addition of the three. That is this, and this. I multiplied it by the balance of the impairment loss, which is 750 minus 375 minus 150. That should be 225. Then when I do the arithmetic, it gives me 150. The same thing for the property stations and road tracks. Then I impute all the figures here. So when I take away this impairment loss, it gives me the carrying amount. So when I sum all together, I have the new value. So I've allocated my impairment loss in 2019, in February 2019. In March 2019, all these new value, new carrying amount, I bring them forward. The goodwill is gone, so no more. So I started from the license. So license, the value is now 750. I'm taking it from here. Property stations, 187.5, this. Road tracks, 187.5, this. Then the train engine, 375, that is undamaged. So I need to allocate impairment loss to this. The total impairment loss is 150 because the value fell from this to 1350. So it's 150. Now that 150, I need to allocate it in that same order. First, I need to allocate to damaged assets. In this case, we don't have any damaged assets in March. The second, I need to allocate to goodwill. We don't have goodwill. Then the third, I allocate to other assets on a pro rata basis. In allocating to other assets, I should allocate to these four assets, but I cannot. One, this train engine is already its net selling prices. That is its net realizable value. I cannot impair that further. So I just extend it. I cannot impair it further. the license, they gave us its net realizable value as 675. So I can only reduce it to that limit. I cannot reduce this further. So that was why I only allocated 75 to that, exactly to reduce it to the 675. If you had forgotten, somebody wants to buy the license for 675, and that's the selling price. Then out of the 150, we have allocated 75. The remaining 75 can then be shared among these two other guys based on their relative values. And that's the workings I showed here. 1 is 7.5 all upon 1 is 7.5 plus 1 is 7.5 multiplied by 75. It gives 37.5, 37.5, which I extended here. Okay, so when I take away the impairment loss from their old carrying amount, it gives me these new values. Then puts it down. And that's the end of this question. I was asked the conditions that must exist before impairment loss can be reversed. Number one, there must be an improvement in the indicators of impairment. Number two, the reversal should not lead to carrying amount in excess of what the carrying amount of the assets would have been without recognition of the original impairment loss. You cannot reverse an impairment loss beyond the original value before impairment. It's not possible. It's not. Okay. This is the solution to the first assignment. When I'm updating my notes to you, it's going to be among it. It will be in between it. The second assignment. It says, this one is a professional level question, and they can ask it as skills too. They can. I've seen them, they will ask a question a professional in a diet. In another diet, they will come and ask it in skills. So they said an asset is said to be impaired when its recoverable amount is less than its carrying amount in the statement of financial position. Yeah, true. They said from time to time, an asset may have a carrying amount that is greater than its fair value, but may not necessarily be impaired as the situation might change in the future. Yes. But that's not impairment. That's more like a evaluation deficit. And I said, but impairment means that the asset has suffered a permanent loss in value. The asset has suffered a permanent loss in value. And there are many factors that can affect the quality of impairment accounting and disclosures required. Discuss with particular reference to group accounts the two factors which would be important when conducting impairment tests under IAS 36. We're given that for 8 marks. And I need not tell you that the two factors are basically carrying amount and recoverable amount. Those are the two factors. All you just need to do is just to discuss this with reference to group accounting. And every one of you know here, because I've taught you, that carrying amount is cost minus accumulated depreciation minus accumulated impairment losses. For group account, carrying amount of a group is the addition of the carrying amount of the parent and that of the subsidiary. You then go ahead and explain recoverable amounts, being the area of value in use and net realizable value. You explain value in use to them. You also explain net realizable value to them. I have the solution here for you. You can read it up. The B parts. It says Pepe PLC is an entity that regularly purchases new subsidiaries. On June 30th, 2019, the entity acquired all the ordinary shares of Bobo Nigeria Limited for cash of 390 million. So this first paragraph is telling us that Pepe Nepe bought all the shares of Bobo for 90 million. Now states that the net assets of Bobo Nigeria Limited as at acquisition date were 270 million, and no fair value adjustments were necessary upon consolidation of Bobo Nigeria Limited for the first time. Okay, so the company we bought, the net asset is 270 and we paid 390. That means the goodwill is the difference, which is around 1390, around 120 as the goodwill. So, and no fair value adjustment necessary. Okay, that's fine. Then I said on December 31st, 2019, Pepe Nepe carried out a review of goodwill on consolidation of Bobo Limited for evidence of impairment. So after preparing his consolidated account and he has recognized goodwill in the consolidated account, he then went ahead to carry out a review of impairment, a review of the goodwill for impairment loss. Now, what was his findings? He says the review involved allocating the net asset of Bobo Limited into 3 CGUs and computing the value in use of each unit. So apparently, when he wanted to do his value in use, he saw that a lot of the assets, you cannot individually get their value in use. So he needs to get CGU. And you know that that's how you solve that problem. You group assets together that makes money together, which is what this guy has done here. So him now is having 3 different CGU. Okay, basically to get their value in use for each of the units. So we're given the carrying amount of each unit, which is their book value before impairment adjustment. And these are the items there. We have patents was in CGU 1. CGU 2 and 3 does not have any patent. PPE, they give us the value for each CGU. Net current asset, they give us the value for each CGU. And this is the total asset. And now we're given the value in use of each of the CGU. Now to that, it is not possible to allocate goodwill on consolidation to the individual cash generating unit. Of course. So that's why you can't find goodwill in any of the CGU. Right? Goodwill is entity based. Goodwill relates to the entire company. So we cannot say this goodwill belongs to part of this company. No, it's entity based. But all other net assets of Bobo are located in the above table. So they could easily allocate other assets to CGU, right? They said the patents of Bobo Limited have no ascertainable market value. You see, this sentence tells me that the patent has been impaired fully. They said the patents of Bobo have no ascertainable market value. That means this 7.5 million is gone. Is fully impaired. Not only that, they also said, but all current assets have a market value that is above carrying amount. So this is a scenario where they are mentioning about current assets. They said their values are above their carrying amount. That means don't allocate impairment loss to them. Don't touch them. Don't touch them because their market value is above their carrying amount. So they have not been impaired. So that's why in most cases, even if they don't tell me this, I will not touch the net current asset. They now said the value in use of Bobo as a single CGU as at December 2019 is this. Can somebody help me add this three? Does it add up? Does it equal this? I just want to confirm something. Can you help me add this three? Does it equal this 307.5?
No, sir.
No, sir.
What do you have?
295.5.
295.5. What's the difference?
12 million.
Where is that coming from? Anyone? It's quite surprising to me because since they broke down the individual CGU, when they broke down Bobo into individual CGU, and they gave us the value and use of each of the CGU, right? So they now also give us the value and use of Bobo as a single CGU.
Goodwill.
So it's now above the individual CGU. What will have caused that?
Goodwill.
Goodwill. Yeah, Goodwill. Yes, it's part of it. It's majorly it. Or synergistic effects. Because when you put them together, they tend to have much more value than when you put them separately. But that does not mean the value of goodwill is the difference or no, but it might also have contributed to some money when you looked at it as a single individual unit. So that makes sense, for sure. Okay, so we're now asked to discuss how impairment loss in CGU1 will affect the carrying amount of the net asset of Unit 1 in the consolidated financial statement. So discuss how impairment loss of, so when they say discuss, it mean discuss. It's different from just calculate. So you're supposed to discuss how, so that means you would use relevant figures and explanation. So ordinarily, the carrying amount of CGU1 is this, the value in use is this, the difference is like the impairment loss. So discussing means explaining how you're going to allocate that impairment loss to each of these items, the 7.5, the 90, the 30. And you know that part of the things you discuss is to explain that we're told that this patent has no ascertainable market value. So you need to impair it fully. And also, whatever is now remaining will be allocated to other assets on a pro rata basis. But again, this 30 is value is already above market value. So you are not going to impair it at all. Then whatever impairment balance would be strictly given to PP. You need to explain all of that. So, and this is how I explained. I said, in the case of a CGU, impairment loss determined will be allocated to individual assets within the CGU in the following order: fiscally damaged assets, goodwill, and other assets on a pro rata basis. I said for CGU1, the impairment loss will be allocated first to patent as it has no ascertainable market value. Then the remaining to PP. I said the net current asset has a fair value that is higher than its carrying amount. We cannot allocate impairment loss to it. And this is demonstrated below. So very straightforward. So these are the carrying amount as given in the correction. Okay, I was able to arrive at this impairment loss, which is the carrying value minus the value in use. Then this I shared first to patents because it has no ascertainable market value. Then whatever is remaining out of this 19.5, which is 12, I gave that to patent, to PPE. Okay, so you see that I didn't touch net current asset at all. So when I take away the impairment loss from the carrying amount, I got these new values for the CGU1. Now for CGU2, we're asked to calculate and explain the effects of the impairment review on the carrying amount of the goodwill on the consolidation of Bobo So now they want us to calculate and explain the effect of the, you know that this company said it wanted to review its goodwill for possibility of impairment. Okay. And to do that, you will need to assess the whole business, the entire business, which was what we did in the solution here. Okay, I said impairment loss determined from CGU is allocated to this, and this. I said CGU1 has an impairment loss of 19.5. Okay, why CGU2 did not suffer impairment loss, hence the entity-wide impairment loss computed to be allocated to CGU1, then to Goodwill, and this is demonstrated below. So firstly, I determine the goodwill amount, which is cost of acquisition minus the purchase consideration, as given in the question of Bobo. Then I added all the assets in the CGU together. I've got a total of this. So this 420 is like the value of the entire business. And the value in use that they gave us together was 307.5. So the impairment loss is 112.5. So from the solution one, I already know that CG1 was impaired by 19.5. So I just spread it based on my solution in one above. So patents and PP, I take away the 7.5 and 12. Okay, which was what I explained here, that CGU1 has an impairment loss of 19.5, while CGU2 and 3 did not suffer impairment loss. And I was able to say that because they didn't tell me anything to the contrary. I cannot assume that they are impaired. So after I've taken out 19.5 from these 112.5, the balance, which is 93, I gave it all to Goodwill. So the Goodwill here did not fully impair, still remaining 27, which is fine. The total PP is now this. The non-current asset, you don't touch it, is this 97.5. Then if I add it together, it brings me to the new value in use of 307.5. And that's the solution to this question. And then there are a lot of questions on impairment loss that you can practice. A lot, plenty in your past questions. So if you need help with it, you can call for it. But at least, even the one I've given you, most of you are not doing it. Try to do it, try to revise. For the guys in skills, look at all your notes that I've been collating, just working notes that I've been collating. By the time I'm done with group next week, this note has built up to 133 pages already. And how many weeks class have we done? It's like the 7th week. So before we do another one, we'll be having a note of close to 500, let's say 300 pages already. That's just working note though. That's just like your class notes that I'm giving you. So you need to double up and read so that you won't accumulate a lot of things that will then discourage you from writing the exam at the end of the day. All right. Let's start a new topic. Group account. For you guys in skills, this is 20% of your exam. For the guys and professionals, it's 30% of your exam. So this class is particularly important for everyone. And I hope to finish it next weekend. That's my hope. So group accounts, why are we talking about it? Why do you want to prepare it? This is the reason. The reason is intercorporate investments. It's because companies are investing in another company and they have reasons for that. Either because they want to enter a new market, a new industry, a new country, they want to enter a new market, or for tax planning, maybe there's a jurisdiction where if they have holding in that jurisdiction, they pay little or no tax, or there's a company where if they invest in that company, they can get some economic incentives from the government for a lot of reasons. So tax planning is part of those reasons. Some companies can have surplus funds, idle funds, a lot of cash flows, sort of sitting idle in their bank. They decided to invest it in shares. They buy shares, and because the money is so much, so they invest in companies. Others is for portfolio diversification. They want to have a balanced portfolio so that they can decrease their alpha or beta risk to a significant reduced level. They want to decrease their exposures to a very a reduced level, so portfolio diversification. Some is just for financial returns. They want to get interest, they want to get dividends periodically, so they invest for that purpose. Some is targeted towards strategic control and alliance. They want to have control over a company. They want to have significant influence over a company. They want to do backward integration. They want to do forward integration. So lots of reasons and more why companies invest in another. And this intercorporate investment is the only reason why at the end of the day, we will have to prepare group accounts. So how do they do these investments? See, these investments are done through either a debt instrument or equity instrument. The focus for group accounts is equity instruments. Debt instruments will not make us prepare group accounts. I'll teach you debt instruments under financial instruments. I'll teach you that when I'm done with group accounts, the very next thing I'm teaching is financial instrument, then lease and other ones. So debt instruments will not make you prepare group accounts. So what would make us prepare, the investor prepare group account at the end of the day is when he invests in the equity instrument of another entity. So that's the focus. I'm not talking about debt here at all. So you see, when a company invests in equity, it will result in these types of investments. Number one is investment in subsidiary. Number two is investment in associates. And number three is simple investment or financial assets or equity investment. So those are the three types of investments that can arise from equity investment. And there's one that I just intentionally removed, which is joint interests or joint investment or joint venture, where you have equal holdings with the other counterparties. So this investment in subsidiary is where your equity interest is above 50%. This investment in associates is where your equity holdings, equity interest in another entity is 20%, but less than 50%. So it's between 20 and 49.99999. It's not up to 50%. While financial assets or equity investments is where your equity interest in the investee is less than 20%. So basically, this is the type of investment we want to discuss in this topic, group account. And they usually arise when you invest in the equity instrument of another entity. And I know that every one of you here knows, can give me examples of equity instruments. So who can tell me an example? When I say invest in equity instruments, what specific instrument? Can you give me an example?
Buying share capital.
Thank you very much, Ashaiton. Seems you are the only student I have in this class. You and Moses. Yeah. So buying share capital. Is Moses around today? He's not even here. Okay, I think he's here. So that's share capital majorly, ordinary share capital to be specific. Maybe preference shares too, but that one has a long story behind it because it can be debt. Preference shares can be debt instrument at times. We're going to learn all of that under financial instrument. Okay, you know that everything we talk about in reporting, everything, there's a standard behind it. So for investment in subsidiary and associates, which is the focus, because this one is going to be covered under financial instruments. It will not give rise to group accounts. So the focus majorly is investment in subsidiary and investment in associates. So these are the standards relevant for that. There is a standard called IFRS 3 on business combination. There's a standard called IFRS 10 on consolidated financial statements. There's IAS 27 on separate financial statements. And there's IAS 28 on investment in associates and joint ventures. These are the focus. These are the standard that we use to teach you all the principles you need to know. And everything I'll be mentioning are statement from these standards. It's not what I developed, it's just what I read from these standards. And that is how we're going to account for most of these types of investments. So let me pick up investment in subsidiary. You know, I told you that where an entity acquire equity interest in an investee, okay, it will result in investment in subsidiary where its holding in that investee is above 50%. So when you buy shares that your holding in that company is above 50%, we call that type of investment in subsidiary. Okay, as I was saying, you see, when you have investment in subsidiary, it simply means that your holding is above 50%. And what that gives you is control. It gives control to the investor. Control, of course, over the investor. So, but you need to understand something, that this control can arise even if your holding is not up to 50%. Okay? That therefore means that even though I've been saying that for you to have an investment in subsidiary, you must have bought shares that your holding in that investee is above 50%. And that gives you control. But you can get control even if you don't have up to 50% holding. Right? And if that's the case, it therefore means that you still have an investment in subsidiary, even where you don't have up to 50%, because you have control. So we're going to look at that situations that can give you control even when you don't have up to 50%. Every one of you here knows Tedola. You know that presently is the chairman of First Bank. Yeah. And he was able to become a chairman because he was buying a lot of shares in First Bank. If you check Otedola's holding in First Bank, $, holding interest. I'm trying to Google it, though, by the way. Interest in First Bank. I want to check if it has up to 50%. So Google tells me here that as at January 2026, his holding is 18.1%. But he was appointed as chairman in early 2024. So he used his investment vehicle called Calvados to acquire substantial shares, and his aim is to stabilize the bank. So my point here is this: he is able to become a chairman because he has a lot of shares, and his holding is not up to 50%, but he has control. So why? So we need to look at that. So that means investment in subsidiary can arise even if you don't have up to 50%. If you can prove some things, then you have control and you can consolidate. Okay, I mean, I'm going beyond what I've mentioned. I've not really mentioned consolidate, but yeah, it's talking about control. So the key indicator of investment in subsidiary is perhaps control. And when we say control, it means that it says here that an investor has control over an investee if the investor has exposure or rights over the variable returns of the investee from its involvement with the investee and has the ability to affect those returns through its power over the investee. So you really need to know this formula, this definition. And the reason I'm not typing today is because I want to finish it in 2 weeks. I'm not rushing, but there's a lot to type under this guy, and it's not worth it. Yeah, it's not. So you really need to um, you really need to know this formula. You really need to know this formula, this definition. So again, an investor has control over an investee if the investor has exposure or rights over the variable returns of the investee from its involvement with the investee and has the ability to affect those returns through its power over the investee. So I broke down this element of control. They can ask you in the exam the element of control. So number one is exposure or rights over the variable return of the investee from its involvement with the investee. So when you are exposed to or you have rights to variable return. So when we say variable return, we mean the sales, the income of that investee. So when you're exposed to it, exposure means if he's making a lot of money, you benefit. If he's making loss, you also lose. So you're exposed to it. And also you have right over it, meaning you are part of the people that will share in it. That's the first part of this definition. And two is this: you can affect those returns through your power over the investee. Control gives you power. So that's the second element, power over the investee. And you can use that power to affect those variable returns. Meaning you can decide what you want to share to people and what you want to retain because you have power over those returns, right? That's control. It's that power that signifies control. You can control what they do with the money. You dictate it. I mean, I heard in news recently, still on $1, he mentioned that they have cleared up their 700 billion bad loans. So I think they declared a loss in this last year, financial year. And they said the bank is strong because they have good earning base, so they're fine. But they wrote off over 700 billion to P&L. Right? I mean, he can make that decision. He has power. They can decide what they do with their returns. So when we say power, we're talking about an existing right that gives the investor the current ability to direct the relevant activities of the investee. Like I was saying, it's a right. It gives you the ability to direct their relevant activities. You direct it. And these existing rights, how do you get it? How do you get that right? Of course, we have mentioned it before. You either get it directly through buying of shares that is above 50%. When you have a lot of shares above 50%, it gives you that right that leads to power. It might be indirectly. You can have these rights indirectly. Of course, you must have bought shares, but in case your shares is not up to 50%, like in the case of $1 now, you might still have these rights. And this can be gotten, or it can be shown where you can do the following. You can appoint, remove, reassign key management personnel of the investee. You can appoint, remove, or reassign an entity that directs the relevant activities of the investee. Can direct the entity to enter into transaction in your favor, and you can carry out activities in line with a management contract. So when you can do any of the following, even if you don't have 50%, it shows that you have power, which shows that you have control over the investee. So that investment in subsidiary, it gives you control. That gives you the power to affect the variable returns of the investee. And this power that you got from some rights that it's either coming directly through buying of shares or indirectly through the fact that you can appoint and fire key management people. You can direct their relevant activities. You can direct the entity to enter transactions in your favor. You can carry out any other activities as specified within a management contract and that. So when an entity has an investment in subsidiary, we call the investor a parent. We call the investee a subsidiary. That's the introduction to investment in subsidiary. Then investment in associates. So this will arise when an investor acquires equity interest in an investee and his holding in the investee is between 20% but less than 50%. You see, these investments would give the investor what we call significant influence. And again, you can have significant influence even if you don't have up to 20%. Just like you can have control even if you don't have up to 50%. The same thing applies here. So majorly, you can have investment in associates if your voting rights in the equity of the investee is 20%, but less than 50%. And this holding gives you significant influence over the investee. And this significant influence, you can also have it even if you don't have up to 20%. Now, significant influence also is a power to participate in the financial and operating policies of an investee. And this power can arise directly through voting rights by buying shares in the investee of 20%, but less than 50%. So it arises when you buy shares. So significant influence is the power to participate. So yeah, you cannot affect their variable returns. You cannot decide what they do with their money, but you can participate in the financial and operating policies. That's a key difference between control and significant influence. Both of them gives you power, right? But the power or control is a power arising or is a power to affect variable returns. Is a power to affect variable returns, but the power for significant influence is just the power to participate in financial and operating policies. You cannot single-handedly make some decisions. So remember, I told you that you can have significant influence even if you don't have up to 20%. And that will happen if you can demonstrate the following. Number one, if you are providing essential technical information to the investee, that without that information, they can't really function at the level they are functioning, then you might likely have significant influence. Number two, where there is exchange of key managerial personnel between the investor and the investee, when you exchange managerial personnel with one another, when there is also material transactions between the investor and the investee, it also signifies significant influence. Also, where the investor is represented on the board of directors, it also signifies significant influence, and you are represented on the board of directors. Also, when the investor participates in the financial and operating decision of the investee, this also signifies significant influence. So when an entity has an investment in associates, the investee is known as associates, the investor is known as investor or a parent. And that's the introduction to investment in associates. Now, how do we account for investment in subsidiary? So I'm starting the accounting. When I'm done with accounting for investment in subsidiary, then I move to that of associates. Probably next week, I'll finish subsidiary today. So when an entity has an investment in subsidiary, IFRS 10 requires that the entity must prepare a consolidated financial statement. So as soon as you have a subsidiary, you must consolidate. So majorly, what you want to learn here is how to consolidate, really. That is it. That is all you want to learn. How do you consolidate? And when we say consolidated financial statements, so it means a financial statement of a parent and a subsidiaries that is prepared as if it is that of a single entity, economic entity. That if somebody looks at it, you will think is for a single entity. You will not know that is for two or more entities combined. You will not know. You will think it's that of a single entity. So how do we achieve that is what we are going to learn. How do you prepare financial statement of a parent and its subsidiaries? How do we combine them together for it to look as if it's that of a single entity? Now, before then, there are some things we need to consider before you go ahead and prepare consolidated financial statement. Number one is what we call potential voting rights. And these are majorly instruments that can become ordinary shares or equity in the future, like options, warrants, convertible debts. These are instruments that can convert to shares. You see, these instruments, you need to consider them to know whether you have control. That if these guys should convert in the future, will I still have control? Will I still have control? Will I still be able to affect their variable returns? Will I still be able to fire and hire key management personnel? Will I still be able to have over 50%? So you need to consider it today. Potential voting rights is a major consideration in determining whether an entity has control or not. Another one is exemption from preparing consolidated financial statements. So before you go ahead from preparing consolidated financial statements, aside that looking at potential voting rights, you must also consider the exemption allowed in IFRS 10. So if the following exists, then you might not necessarily prepare a consolidated financial statement. Number one is that if you yourself, you're an wholly owned subsidiary or a partly owned subsidiary of another entity, and your owners, they don't object to you not preparing consolidated financial statement, meaning that even you that you are a parent, you too, you have a parent. You have a parent, somebody owns you wholly or partly. And they don't care. They don't because they will prepare consolidated financial statements. So they are not really bothered about you preparing or not preparing. Yes, you own another entity. Your own subsidiary are looking forward to your consolidated account. But because you two, you have a parent, those ones will consider all of you, including your own subsidiaries. So if you are also a subsidiary, wholly owned or partly owned, you don't need to prepare console. You are exempted. Two, if you are not listed, if you are not a listed entity, it's not compulsory for you. You are exempted. If you are not in the process of being listed, you are exempted. And of course, like I mentioned, the ultimate parent company prepares consolidated financial statement. So gives you proper exemption. They can ask this in the exam. Right? We ask you to list some situations where a parent can be exempted from preparing consolidated account. Another one is exclusion of a subsidiary from consolidation. So a parent cannot exclude a subsidiary from consolidated financial statements. You cannot exclude. You can only exclude when you lose control over that subsidiary, when you don't have control over it again. So before, people were using this for creative accounting, then they would just decide that they don't want to they would just exclude the subsidiary for no genuine reason. Probably they have seen that the subsidiary is loss making, or the subsidiary has a lot of liabilities and they don't want to be a party to that. They will not just include that subsidiary in consolidation. But that's not possible again, because you can only exclude a subsidiary only when you have lost control of that subsidiary. That needs to be noted. And also, you need to have the same accounting policies with all your subsidiary before you can consolidate. If this is not possible, you need to make adjustment to the subsidiary's account just so that his account is ready for consolidation. But primarily, there has to be uniform accounting policies. The same thing applies to year-end. You guys must have the same year-end, uniform. The parent and subsidiary must have the same year-end. Again, if it's not possible, you can still consolidate if the difference between your year-end is less than 3 months, less than or equal to 3 months. Then you can still consolidate. But even at that, you need to make adjustment for significant transactions that would happen between those periods. You need to bring them in. You need to make adjustment for significant transactions. But primarily, you should have the same year-end. So all this needs to be considered before you go ahead and prepare consolidated financial statements. Potential voting rights, are you exempted? Can you exclude a subsidiary? Make sure you guys have uniform accounting policies. Make sure you guys have the same reporting dates. And again, the fact that you are preparing consolidated financial statement does not then mean you will not prepare your own financial statement as an individual entity. So you will still need to prepare separate financial statements. And in your separate financial statements, you see that your investment in subsidiary, you must account for it at costs. cost or at fair value in accordance with IFRS 9. So IFRS 9 on financial instrument deals with this. I will teach you. So your accounts, when you buy shares in another company, you need to put it in your books as an investment in equity, either at cost or at fair value. Okay, using the principles in IFRS 9. And again, if you have subsidiaries and you decide not to prepare consolidated accounts, you need to make the following disclosures. I've seen this question before for 5 marks. That an entity decide not to take advantage of the exemption, what are the disclosures it must make? Very simple and logical. Number one is that you need to state the fact that this financial statement that you are preparing is just a separate financial statement and is not a consolidated financial statement because you have actually keyed into the exemption from consolidated. Then you need to tell us the name and country of incorporation of the entity that is preparing the consolidated financial statements and the address where those consolidated financial statements can be obtained. That is your own parents. You are a parent to others, but you too, you have a parent. So you decided not to prepare consolidated account. But you need to tell us so that for those of people that need a consolidated account, you need to tell them the name and country of incorporation of the entity that is preparing, and also the address where they can get that consolidated account. You need to also tell us all your significant investment in subsidiary, associate, and joint ventures. You need to tell us and how you have accounted for those investments in your books. I've been saying group. When we say group, we mean parent and its subsidiaries together. We call them a group. Here's what you find in a consolidated financial statement. Number one is the parent separate financial statements, then all the other statements consolidated statement of financial position, consolidated statement of profit or loss, consolidated statement of cash flows, and notes to the accounts. And also, there also be consolidated statements of changes in equity as well. So this is what you find in a consolidated financial statement. Now, how do you consolidate? How do you consolidate? Basic consolidation procedures. So the principles of consolidation is very straightforward, very simple. Like I mentioned before, we use a method called consolidation method. And from the definition of consolidated financial statements, we said it's a financial statement of a parent and its subsidiaries prepared as that of a single entity. Okay, in order to achieve that, it means that we must use a principle called cancellation, so where we are going to cancel out similar items, that appears as assets in the books of the parents against a similar item that appears as liability or equity in the books of the subsidiary, and vice versa. You cancel them out. Any similar items that appear in the books of the parents as an asset, and the same item is appearing in the books of the subsidiary as a liability or equity, cancel them out. They are the same thing. If you consolidate, that means you're having the same item up and down. You cancel them out. They are the same. Then, when you have canceled those similar items, then you combine the remaining items that were not canceled out. That is what we want to do. Believe me, that is it. And when we say canceling out similar items that appears as assets in the books of one entity, and the same item appears as liability or equity in the books of another, what are those items? I would categorize them into two. Number one is in the books of the parent, it would have investment in subsidiary. I told you when he's preparing his own separate account, he needs to recognize that investment in subsidiary there at cost or in accordance with IFRS 9 at fair value. So this has to be cancelled out against the equity in the books of the subsidiary because it's the same. Because that investment you are seeing in the books of the parent is represented by equity in the books of the subsidiary because that is the shares the parent bought. What the parent is having as an asset, as investment, the person you bought shares from him, you'll be having it as share capital in his own books. When you want to consolidate, you can't consolidate those two items again. They are the same. Cancel them out so that, you'll not be carrying the same thing. It will not show as a single economic unit. You want to see their financial statements and think that, okay, this is a company, not saying that these are different, they are different companies' books put together. We want to see it as an economic unit. Aside that, where the parent buy goods from the subsidiary, we need to also cancel out trade receivables and trade payables in their books respectively. Not just trade receivables and payables, any other items that can arise from this, that can arise from them transacting with one another. So when they transact with one another and it's leaving out balances, maybe one is owing another, cancel them out. That's all we want to do. That is all we want to do. So Moses, I saw your hand. Do you still want to ask a question?
Yes, sir. My question is related to, since you said cancellation, I think preparation of financial statement, you mentioned of offsetting. Offsetting is absolutely wrong. So is this one are not going to affect offsetting?
Yeah, that's a very fantastic question you've asked, Moses. So yes, IAS 1, the defunct IAS 1, now replaced by IFRS 18, talks about offsetting. So this is where you have a single entity that carries out transactions with another entity and is owing that entity, and that entity is owing him in his own individual account. So we want you to present those separately as asset and liabilities. So as a single entity, let us see all your assets, let us see all your liabilities. Don't cancel and don't offset, right? And of course, IAS 1 also went ahead to mention examples of items that are not offsetting. Like when you have profit or loss on sale of assets, where you have to do offsetting, when you do cost minus the sales proceeds, and when you also do net realizable value, when you do fair value minus cost to sell, when you also do things like, there are quite a number of them where we actually do offsetting, that those ones are not offsetting, or when you're getting the value of inventory net allowance, where you say the cost of inventory minus inventory loss to get a new value, or even when you're getting carrying amount, when you're doing cost minus accumulated depreciation, you cannot call all of those offsetting. Those are just valuation allowances. I'm just trying to go into all of that. However, this is a group account. This is not a single entity account. This is not what IAS 1 is talking about. Each of the individuals entity have already prepared their individual accounts that will show their asset and liabilities separately. This is consolidated account. This is consolidated account. So we just want to see the combined account of the two companies as a single economic unit. So transactions between them, don't put it there again. It's repetition. It will distort what we are trying to achieve. That single economic. If you are owing one another, let it be in your individual books. Let it be in your, don't come and consolidate that again. We want to see your transactions with outsiders, not your transactions with yourselves. We don't want to see that in your account again. It would distort what we are trying to achieve with consolidation. We want to see your account as a single economic unit. We want to see your revenue that you have made from working with outsiders, not revenue you have made from working with yourselves, or from the money you have made from yourselves. Then we cannot consolidate that. that you made money from this yourselves, you are owing one another money, you would usually cancel out all of that. All of that. So that's not offsetting, and you're good to go. Okay, so look at this. Look at this. I'll give you 2 or 3 minutes to look at this. Sync it. This is everything we want to discuss. It's not more than this. So it's not more than this. Everything else that is coming out, everything, this is the bedrock. This is where it's standing. All I'm doing is canceling out similar items. Consolidation is so easy. You see, before, for the FR guys, before now, consolidation used to be the compulsory question as number one. I said, okay, why you? Because they will ask many adjustments and all of that, as if it's that important. No, it's not. In real life, hardly would you see people do consolidation in their various offices. It's mostly done by auditors at the end of the year. It's for companies that are mostly you are doing your individual company. That's more important. That's why you see the compulsory questions for the FR guys is published. That's the compulsory. Is that they ask you cash flow, or they ask you P&L, balance sheet, or they ask you ratios and all of that as compulsory question. They will not ask you consolidation. It's simple because they will give you account of individual, you consolidate. Even if you don't do anything and just adding the items together, and if you're able to identify similar items, cancel that one out. Anyone that is not similar, add them together. That's it. If you can have this in your mind, then we'll keep it simple so that we'll not waste too much time on learning the simple concepts. The simple concept. And for the guys in SBL, this is still particularly useful for you because it's still your own question one, but the manner in which the exam is asked is beyond consolidation. They still really need you to understand a whole lot of accounting standards. They really need you to do a lot of adjustments before you can scale through. So that's why I want to take this very fast. Okay, Moses.
Sir, sorry, but it's possible for us to consider netting a balance, right? Let's assume that in the book of parents, we have an asset of 1,000 naira. Then in the book of subsidiary, we have an asset liability of 500. Is it possible to net off and just use 500 naira in the book of parents? 1,000 naira to 500. Is not the figure are not the same.
So that cannot happen, because what we are looking out for is where there are transactions between the two of them, we expect the figure to be the same. We expect the figures to be the same. If they are not the same, that means that one will probably be still outside. And the situations where you have that is where you have like goods in transit or cash in transit. So it's not within the group, it's still outside. We consolidate that. But when people consummate transactions, when I buy from you, is my at costs, my receivables should be equals to your payables. If you have paid me some, it should be the same. Okay? So if they are not the same, it means that there is an imbalance that needs to be reconciled between the two of us. But it should be the same. Please, let's take like a 5-minute break. I'll be back by what's time now? 15:44. I'll be back by 15:50 for us to start solving questions to apply consolidation method.
All right, sir.
Yeah. Okay, I guess I'm 2 minutes late or 3 minutes late. So let's then continue with our class. So far, we have been discussing group accounts, and I started with intercorporate accounts, and I said I started with intercorporate investments. That this is what usually give rise to. So this is what gives rise to group accounts. And this intercorporate investment can either be done using equity instruments or debt instruments. And I said our focus is equity instruments. Debt instruments, we are going to talk about that under IFRS 9. And for equity instruments, when you invest in those instruments, is either you are having investment in subsidiary, investment in associates, or investment or equity investment or financial asset. So investment in subsidiaries where your shares gives you an holding of over 50%. Investment in associate is where your holding is between 20% but less than 50%. Financial assets is where your holding is less than 20%. And all of those is equity investments. You have invested in equity. Then we said investment in subsidiary is that in which gives you control. And you can even have this control even if you have less than 50%. And I told you scenarios where that can happen. Investment in associates is the one that gives you significant influence, which is the power to participate. And you can have this significant influence even if your holding is less than 20%. And I showed you scenario where that can happen. Now, we started with accounting for investment in subsidiary. That when you have a subsidiary, meaning you have control, IFRS 10 requires that you must prepare a consolidated financial statement, which is a financial statement of the parent and its subsidiaries that is prepared like that of a single economic unit, meaning that all we want to see are the transactions the two of you have with outsiders. We want to see you as a single unit. We don't want to see transactions you have with yourself. And that is why the approach to consolidation is what we call an acquisition method or a consolidation method using cancellation rule. And that's all it is about. So consolidation is as simple as adding the individual accounts of the parent and the subsidiaries together. And any similar items, cancel them out. So the major work we want to do is just cancellation. Looking out for transactions between the entities and cancelling them out. That is the major work. Every other, you will see. And examples of such, I said, when in the parent book, you have investment in the subsidiary. In the subsidiary, you have equity. The same items, cancel them out. Or where they sell or buy goods from one another and they're having receivables and payables, cancel them out. Any form of transactions between one another, cancel them out. That is what we mean by consolidation. So I have some illustrations here for you that deals with some theory part of what I've taught you. You can look at those. But now, this is the first question we're going to look at. Now, Shidera, please, let's read up. And let's read up very fast because we'll be solving like close to 12 questions before we go to that. Shidera, let's go. Read the first one.
Okay.
Sure. Okay.
PCO acquired 100% of the equity of SCO since incorporation of SCO on 31st December 2017. The statement of financial position of the two companies on 31st December 2017 are given below. All figures are shown to be correct. Required. Prepare the consolidated statement, financial position of PCO at 31st December 2017.
All right, thank you. Yes. So not PCO is PICO. So like the name of the company is P. This co is company or limited, something like that. So PICO acquired 100% of equity of ESCO since incorporation, which is 1st December 2017. And we're asked to prepare, they gave us statement of financial position of each entities, and we're asked to prepare consolidated. Now, consolidation is as easy as adding these items together individually and looking at for similar items to cancel out. Now, based on my explanation here, who can point out the similar item here on these accounts of PICO and ESCO? Where is the similar item that is appearing in the books of PICO and is also the same thing in the book of ESCO, that is transactions between one another? Can you see any?
Good afternoon, sir.
Hi, Olamileko.
Yeah, investment in ESCO, the 60,000.
Okay. Okay, this one.
Yes, sir.
Okay. What is it representing? Where is it in the book of ESCO?
Equity. The
Equity.
ordinary share capital and the share premium.
Thank you very much. These two needs to be cancelled out, because when we say equity, it means ordinary shares and share premium. So they are the same thing, is from transacting between one another. This investment that this guy is putting in his books is because he bought shares, he bought 100%. So when he buys, when you buy 100%, what you own not just the shares, but the asset, everything, asset and liabilities, which is represented by equity. So the net asset of a company should be equal to his equity. So we are working with equity here, which is ordinary shares plus reserves. You bought everything. So you will not, these are the only things you will not consolidate. And I've done the workings for you. I say cancellation. I compare the consideration transferred in the books of the parent against the net asset acquired, which is equity, in the books of the subsidiary. Like Lakon said, shares and share premium, which is also 60. They cancel out. Every other items, I just added them together. PPE, this 382,500 is the addition of these two. This one has been cancelled out. There's no need to add. This current assets is the addition of this 70 and 100, which is 80. So this. Then ordinary share capital, this 100 is just that of the parent because this has been cancelled out. The share premium is this because this has been cancelled out. So we only consolidated the parent. We have cancelled out the subsidiary. These retained earnings is just the parent alone because the subsidiary does not have. The current liabilities is the addition of the two, 62,500. Very straightforward. It's just cancellation. Shidera, read the next one.
Okay, sir. Please go.
I've scored. Yes, study from you.
Okay. PICO regular sales goes to its subsidiary company, SICO, which it has owned since SICO's incorporation. The statement of financial position of the two companies on 31st December 2017 are given below. Statement of financial position as 31st December 2017. All figures are assumed to be correct. Required. Prepare the consolidated statement of financial position of PICO at 31st December 2017.
Okay, thank you very much. So for this one, they do transactions with one another. So because they said regularly sells goods to subsidiary, which is as own since incorporation. So the statement of financial position of the two companies are given below. So they gave us statement of financial position of the two. So again, cancellation. We just cancel out similar items. First, the investments in shares in ESCO will be cancelled out against the equity of ESCO. To cancel out, we won't consolidate that. That's one. Two, I can see receivables here. They wrote ESCO, which is 1,000. Will be cancelled out against the payables, which is also 1,000. So these two will also cancel out against the other. I was able to know that because they wrote ESCO here and they wrote PICO. If they hadn't, I won't cancel them out. I can't assume that they are similar items. I can't just assume. It was because they indicated that these are receivables from PICO and these are payables to PICO from ESCO and these to PICO. And they are the same amount, so they cancel out. And that's all. This one, I would know this one by default because they said they invested in ESCO. I know that this investment will be represented by the equity of ESCO, which is usually share capital and reserves. Okay, hold on. I'm not considering this 9.5. Why? Shouldn't they be cancelled out? Is it not part of equity? Anybody? We need to cancel out this 9.5 too. Because if you are cancelling out 20 against 20, fine. But if you are cancelling out 20 against 29,500, then there's something wrong. So the reality is that we cannot cancel out this 9.5. Can anybody figure out the reason why they are not the same? Why this 20,000 does not include this 9.5? Can anyone figure it out?
Good afternoon, sir. Good
Hi,
evening.
hi.
Probably I
Michael.
should just try.
Okay, please do.
I'm thinking because so this is a this is a pre-acquisition retained earning which the parent company didn't contribute. So he's not going to consolidate that. It's only post-acquisition retained earning that can be consolidated, which he or she contributed in. That's
Okay.
just my take, my guess.
Okay. So nice one. Just to wrap up what you have said. So this 9.5 now, what is it exactly?
Retain earning at date of acquisition.
Retain earnings at the date of acquisition. Okay. So Michael, did she speak your mind?
Yes, so since it is before acquisition, the parent company didn't contribute to getting this retained earnings, so it's not going to consolidate that. Only post-acquisition retained earnings. So that's what she said. I'm in line with that, sir.
All right. Okay. No problem. You guys tried. So let's compare what you mentioned with this. So this 9.5, we won't consolidate. You know me, I haven't mentioned anything around pre-acquisition, post-acquisition. I've not really mentioned anything around that at all because I'm not really bothered about those terminologies. I'm bothered about practical understanding, right? So I think Shaya wants to say something. Let's hear you out before I go ahead.
I just want to confirm, does this have anything to do with cost or fair value, that we need to consider the cost of fair value? Because 20 is 20. Okay. All right.
No.
So, sorry, I wanted to say that, they said that Pico already owed ESCO since incorporation. So they already like this 95 is still going to go to like I don't agree with what they said, Sha. That's what I'm saying.
Okay, that's well noted. And you were actually moving in the right direction. Okay. Yeah, let's hear you out, Mustafa.
Okay, good evening, sir.
Good evening.
Yes, my own contribution is that the investment in ESCO is stated, oh, sorry, in Pico, yeah, it's in ESCO, sorry, is stated at cost. And so that is why we have that value of 20,000 separately. But the retained earnings, since Pico also owns the whole of ESCO, the retained earnings is also owned by Pico invariably.
Okay. So, I mean, why are we not canceling? Why can't we cancel out this 952?
Okay,
Because
sir, let me just provide some clarity. So I think in consolidation, under the equity section, only the equity of the parent company will be shown on the
why?
face of the financial statement.
Why? Okay.
Well,
Don't
you're our
worry.
leader. Maybe you should help us, sir.
Oh, definitely. Right. So, yeah. So I don't want you to, I call it rote learning, ROTE, rote learning, like as if it's a law. Like maybe probably somebody has taught you in some way, like this is how you do it. This is how you do it. I mean, I don't like learning that way. Everything has a reason. It's not about terminology, it's about the simple reasons for doing things. And are really very basic and simple. So this is not far from what I've been saying. Cancellation. I need to cancel out similar transactions that relate to one another. So this guy invested 20,000 to buy shares, the equity or net assets of ESCO. Now, when I peeked into the equity of ESCO, I saw that it's 29.5. Okay, it has 20,000 and it has 9.5. You see, 20,000 is shares. Definitely, yes, he bought that one. But the 9.5, this 20,000 investment, does it cover this 9.5? See, it can cover it. It can cover it if this 9.5 was there at the date of acquisition. If this 9.5 was there at the date of acquisition, it covers it. But this 9.5 was not there at the date of acquisition. It didn't meet it there. It's not there. How did I know? Because he bought ESCO since incorporation, which is what Fashion was trying to say. And I said he bought ESCO since incorporation, since ESCO's beginning. And if ESCO is just beginning, and that's when he invested 20K in ESCO, would ESCO have made any retained earnings? No, it wouldn't have. So this 20,000 is only applicable to this 20,000. That's how I want you to understand it. And which is what you hear us calling pre-acquisition retained earnings, which is the retained earnings that was there when we invested, because we are paying for that too. Because for intercorporate investments, when you buy to a level that you have control, that one is now beyond shares anymore. You have now invested in assets and liabilities of the companies, which is equal to the net asset, which is equal the equity of that company. And equity is shares and reserves. So when you buy at that date, yes, you are buying the net asset. It's also synonymous to that. Yes, you're buying the equity, which is shares and reserves. And reserves is beyond retained earnings. It covers share premium, revaluation surplus, and any form of reserves that you may have that is there when you invested. So we bought these guys since incorporation. You will not have any retained earnings as at that date because it's just starting up. And that is why this is not being cancelled out. It has nothing to do with this 20,000. I need you to understand it that way. I don't need you to understand it that, this is post-acquisition retained earnings. So we will not consolidate. Somebody will ask you why. You don't know. No, you don't learn that way. That is not learning. You are rote learning because you don't consolidate. You will not cram that. You don't consolidate post-acquisition retained earnings. No, don't learn that way. So they are not similar transactions. It's not similar with this 20,000. This 20,000 was used to buy this. And the way I know is because I've bought it since incorporation. If I hadn't buy these guys since incorporation, if I buy it on subsequent days, they will tell me the reserves that were there on the date I bought it. They have to now because they don't expect me to know it magically. They will tell me that on this day, when you bought this subsidiary, these are the reserves you had. I know that I will have bought into that too. My investment to cover all that too. It will cover all that. In this case, it does not cover. It only covers the shares. This retained earnings only came in after. So it's not part of what I bought at all. It wasn't there at the date I bought it. All right. Yeah, Michael.
Oh, thank you very much, sir. It's well understood. So, but you know, a number of us pass through FR and we are in professional, and some
Yeah.
of these things, like you said, is routine. We just given to us for us to use the exams. But it's a bit confusing for me now, based on what you've said, because if as at incorporation that it was incorporated since the incorporated ESCO since. So, and they have this 9,500 because from what we are also told that retained earning computation is as a reporting date, So as at this time that they are reporting this, you already have 9,500. So I am thinking that PICO has already contributed into gaining this 9,500, and since they have like 100%, it should be added back. It should be added as part of their retained earnings.
Yes, it will. It will. So it will be consolidated. We have, that's correct. To be consolidated, but it's not going to be cancelled out. What we're trying to do now is to cancel out items. Then any uncancelled items will be consolidated. Yes, it should be consolidated. So it should be consolidated. Right, Michael? So what we're trying to say now, from what I've explained, you cancel out similar items. So I want to try and cancel out similar items. And I'm asking that because retained earnings is part of equity, that should we cancel out this? Canceling out means that we won't consolidate it. Okay? And I said, no, you don't cancel out this because it's not part of what we acquired. Is not part of what we acquired. Okay, so it's not similar item. So yes, we have a share in this retained earnings. The parent has a share. In fact, the parent fully owns it. So you consolidate that. And this retained earnings is the money ESCO made over time, right? After incorporation. This is December 2017, much more after incorporation. So that will be consolidated. So what we're trying to, that is not adding on cancelled item it's very straightforward. So the major work for us is for us to be able to ensure that we are canceling out, we are able to cancel out similar items. As soon as we do that, others are straightforward. So I think you're missing up some things together, Michael. Okay, I hope I've helped you anyways. So receivables 1,000, this will be cancelled out against this. So now having cancelled out all of that, then, so I've done the workings for you. You cancel out these guys. You cancel out receivables too. Every other items will be consolidated. So the PPE is as good as adding that of the parent and the subsidiary together. 17,500 plus 22,500. That's 40,000. Inventories, adding these two together, which is this 14,000. Receivables, we only consolidate orders because we have cancelled out ESCO. So we are consolidating only this guy, 7,500. Then cash at bank, then we add it together. The ordinary shares, which is equity, which is 35,000. So we are only consolidating this 35. We have cancelled out this 20. So we are consolidating this 35. Then consolidate. We usually call retained earnings consolidated retained earnings. I mean, that is just the tradition. You can decide to call it retained earnings. It does not really matter. It does not really matter. I'm really against this, really. Why they choose to call retained earnings consolidated? Why not call this one to consolidated PPE? This one consolidated inventories, consolidated this and that. So why is it that is this they choose to call consolidated retained earnings? So it's a bit not consistent. So this 17,500 is of course the addition of the two. Where is it? Yeah, this 8,000 plus 9,500, which is what I think Michael was trying to say. He didn't really understand where we're flowing to. We didn't understand where we're flowing to. So we actually consolidate this because it's not cancelled out. So it's on cancelled item, we consolidate 17,500. Yeah, add it together. Then we also consolidate these other ones. Then our account balances like that. Again, yeah, I'm just sizing you guys out just to make it contribute. Don't forget the simplicity. You might know something before, but I'm trying to simplify some things for you. I'm trying to make you understand the very basis of these things. Just open your mind to understand. You can of course compare with what you know before. You see that everything will jive together at the end of the day. So again, still on cancellation, all I'm going to do is I'll just be canceling out similar items. And any uncancelled item will be consolidated. That is all I will do. I will not do anything beyond that, except there are a lot of items to be cancelled. Then I would have to do workings to do some cancellations and all of that. And there might be some balances here and there, which I will need to consolidate at the end of the day. Okay. Shidera, hope you are following and not just reading.
Yes, sir.
All right. Let's read the third one.
The statement of financial position of PICO and of its subsidiaries, SICO, have been made up to 30th August 2017. PICO has owned all the ordinary shares and 40% of the loan stock of SICO since incorporation. Statement of financial position as at 30th August 2017 of PICO and SICO are as follows. All figures are assumed to be correct. Required. So please go.
Okay.
Required. Prepare the consolidated statement of financial position of PICO as at 30th August 2017.
All right. Thank you, Shidera. So this one, they give us a minimum financial position of PICO and its subsidiary ESCO, which have been made up in August 2017. We're told that PICO owned all the ordinary shares, has owned all the ordinary shares, and 40% of loan stock of ESCO since incorporation. So this is the statement of financial position of the individual companies. So again, we need to cancel out similar items. We need to cancel out similar items. And what are the similar items we are canceling out? We are going to cancel out the investment in ESCO because it's clearly transactions with ESCO, which is this 40,000. We are going to cancel it out against the ordinary shares or against the equity of ESCO. But when you look at the equity of ESCO, it comprises 40,000 and 14,000. Okay, so are we going to cancel out the two? Or which are we going to cancel out here? Which of these two relate to this 40,000? Let me ask Michael.
The ordinary shares, sir. Ordinary shares of 1 naira.
Why are we not considering the retained earnings? Why are we not canceling it out?
Because they are not like terms. They are not like terms. So
Why?
that's why we're not.
Why are they not like terms? So the parents, this 40,000 is a payment for investment in equity in ESCO. And because this retained earnings is a retained earnings that came up after we invested, because we bought this subsidiary, we invested since incorporation at the date it started. So at that date, they would have made profits. Retained earnings is cumulation of profits that we did not share as dividend. So this retained earnings was not there. It's not what we acquired. It's not part of what we bought. It's not part of what we paid for. So this 40,000 only relates to this 40 here. This one, like you have mentioned, they are not similar items because he did not pay for it. It was not there since incorporation. It wasn't there. So this 40 cancels out against this. Additionally, Pico also invested 10,000 in the debt of ESCO. Okay. And when you look at the debt of ESCO, it was 25. But we only invested just 10,000 there. That means the remaining 15,000 were investment by other people. Okay. They are investments by other people. So he's owing it to other people, not us. This 25,000, only 10,000 relates to this. And it's clear. And which is synonymous to 40%. So if you do 40% of 25, it would definitely give you the 10,000. So those are the items that are canceling out. And also, I can also see ESCO here. You can see current accounts with ESCO, 9,000. And the same item, current account with Pico, 6,000. So they are not the same amount. There is 9,000 here. There's 6,000 here. So they are not the same amount. If I cancel out the two, there will still be a balance of 3,000 here in this asset side. In the books of the parent, there will still be a balance of 3,000. And they told us that the difference on current accounts arises because of goods in transit, which goes to show that if I want to explain it, for this guy to be having a liability of 6,000 to Pico, is showing that I'm owing you 6,000 Pico, but Pico is having an asset of 9,000, meaning Pico is saying you are owing me 9,000. So the reason for the difference is because Pico actually sold some goods to ESCO that ESCO has not received. which is why ESCO has not updated is what is owing to 9,000. If he had received those goods, it will be showing 9,000 here. So for that reason, we are not going to cancel out that because it's not within the group yet. So we'll cancel out this 6,000 against this 9,000. Whatever is remaining, 3,000, I'll call it goods in transit because the examiner told me so. Even if they don't tell you, you can assume either goods in transit or you assume cash in transit. You can assume either goods in transit or cash in transit. Either one is good. So, and those are the items that I need to cancel out. Every other item shall be consolidated. So, I did all the workings for my cancellations. I canceled out my investments against the net assets of the subsidiary. I canceled out the loan that I bought against the loan in the books of the subsidiary. The remaining 15,000 are loan acquired by outsiders, so I will consolidate that. I canceled out the current account in the books of ESCO against the current account in the books of PICO. Sorry, a current account with ESCO in the books of PICO against the current account with PICO in the books of ESCO. I canceled out that as a balance of 3,000 that I was told is goods in transit. Those are goods for which the transactions is not completed. So I'll consolidate it. It's not a complete transactions between the two. So I can't cancel that out. That needs to be presented. So, and those are all the cancellations. Every other item, you just add them together. It's as easy as that. PPE, I add that of the parent and the subsidiary together. Inventories, receivables, goods in transit that I'm introducing, cash at bank, ordinary shares. So the ordinary shares, because these are ordinary shares, because I've canceled out this 40,000. So this is the parent ordinary shares, like that. And that is what I consolidate. And this one, they usually call it retained earnings. You see me, I just go retained earnings. It's mostly called consolidated retained earnings, which is the addition of these two, 47.5 plus 14,000. And that's what gives us this 615. Add it together. Then I consolidate this, the parent and the subsidiary. This 12%, the remaining 15,000 uncancelled, payables, taxation, just add them together like that to consolidate. And that's that for that. Now, the next one, now this one is now a little different. All the ones we have done, we saw that the parent bought 100%. He bought all the shares. But now we're now seeing a scenario where the parent bought just 75% of ESCOs, since ESCOs incorporation, right? So then you are required to consolidate. So how do we then cancel out? What do we cancel out here? Of course, this investment in ESCO, 15,000, is going to be cancelled out against just this share capital. I won't cancel out this 15,000 because it was not there when I acquired the parent, because I acquired the parent since incorporation. There was no retained earnings there at that date. So I will not consider it as part of what I'm cancelling out in equity. So this 15,000 will only be cancelled out against this 20,000. However, since I did not acquire everything, I only acquired just 75%. Can somebody do 75% of 20,000?
10,000.
15. Okay, good. So 15 will cancel out against 15. So the remaining 5 will be cancelled out. Abi? The remaining 5 will be cancelled out. Sorry. The
No.
remaining 5 will be consolidated. The remaining 5 will be consolidated. So does that mean that our share capital is now 40,000 plus 5? No. No. And the reason is this. When you say share capital means the ownership interest of the owners of that company. It means it represents what you own in that company. So the 5,000 here is not owned by the parents. It is owned by people outside of the group. It is therefore not share capital to the group. Is not share capital to the group. So whatever that is the balance in any uncancelled item in share capital belongs to outsiders. Any uncancelled share capital of the subsidiary, it belongs to outsiders, meaning it is owned by other investors in the subsidiary, and they are not part of the group because the group is the parent and the subsidiary. So the other owners of the subsidiary, we call them non-controlling interests. We call them non-controlling interests. So yes, we have to consolidate it because it therefore means that it's showing that, okay, these 5,000 represent transaction with outsiders, which is what we want to see in the group. So yes, we cannot call it share capital, but we call it non-controlling interest. And the parent is given options on how to measure it. He can leave the 5,000 as it is because the way we have gotten it, we got that 5,000 by using a proportionate share. Because after taking out 75% that the parent acquired, which becomes transactions with the subsidiary that needs to be cancelled out, the balance is 25%. So that's like a proportionate share of the subsidiary's net asset. That's, we consolidate, we call it NCI, and it's part of equity, of course, because it's here. However, the parent can decide to measure this NCI at fair value. It can decide, IFRS 10 allows it, that you can fair value this share capital in the subsidiary that is owned by outsiders that we call non-controlling interest. It allows you to fair value it. So of course, you can see a question that will test your knowledge about how the parent can measure NCI. So the common way is proportionate share, which is what we have done here, just to get it as the balance after taking out what we cancel out, or you can decide to fair value it. We are going to look at that other scenario, and that's the only those are the only two things we would cancel out here. And this is how I solved that problem. So when I was canceling out, I did the money I paid, 15,000, that non-controlling interests that I said we would consolidate, I just added it. I need 25% of 20, which is the equity or ordinary shares of the subsidiary. So I got 5. So these two will then cancel out. So this is how IFRS 10 says we should do that cancellation. It says we should identify consideration transferred plus non-controlling interest. In fact, plus previously held equity interest. I will teach the professional guys there when I'm teaching you piecemeal acquisition. Not piecemeal acquisition, yeah, piecemeal acquisition. So minus net asset acquired in the subsidiary. So what we're trying to do is just at any point in time, we want to compare 100% with 100%. And which is why Michael was saying that the only equity that shows in the books in the consolidated account is that of the parent alone. He does not understand why, but at least he knows that. He's right, but does not understand why. And the reason is that whatever uncancelled item in the share capital of the subsidiary is known as non-controlling interest. Okay? And whenever we have that, this is how we cancel out that part. Just to ensure that we are canceling out 100% with 100%. 100% against 100%. So that's why we make it up with the NCI, just to bring this guy also to 100%. You know, this is 75%. We do hard NCI, then this is the whole share, so we have 0. Now, remember that we don't cancel out this. All we are using this to do is just to bring this up to 100%, just so that it's easily cancelled out. We don't want to get NCI as a balance. Because like I've explained, I can cancel out 15 against 75% of this. I can just do 75% of this. It gives me 15 and I do my cancellation and move forward. I still see some people teach it that way. I see some textbook do it that way, but that's not how IFRS 10 says it. You should do the cancellation. IFRS 10 says money you paid plus value of NCI plus previously held equity instruments minus net asset acquired in the subsidiary. That's how you do the cancellation, just so that you are comparing like with like. So this NCI, which is the part of the share capital of the subsidiary that we did not buy, is owned by outsiders that we call NCI. We need to put it in. We want to see that. So it's 5,000. Now, because this NCI is also a part owner of ESCO, you see that is sharing part of the profit of ESCO because he's an owner. He will collect dividend. He is a part owner of retained earnings. Retained earnings is profit that belongs to all the owners. And NCI is a part owner in ESCO. So that's why he's getting 25% of that profit. This one here, this 5,000 here. So this 5,000 is profits that was made by ESCO after acquisition because we acquire ESCO since incorporation. This profit belongs to all the owners, PICO and NCI. So NCI would get its share. So that the value of NCI is 6,250. It's 6,250, which is 5,000 plus this. So, and finally, the retained earnings, I'm doing workings here because since NCI is now, he has taken a portion of his own, I need to give the balance to the parent. So I don't want to be showing that workings on the face of my account. So that's why it's coming up here. So is the retained earnings of the parents, which is 12.5, as seen here, plus the parent share of this, which is the remaining 75% of this 5,000. So I add the two together, it gives me 16,250. Then I can go ahead and consolidate. See, nothing is changing here. All I'm doing here is still cancellation. I've canceled out this 15,000 against my 15,000. Yeah, my 75% here. But now, there are some people that also owns ESCO that now have to share in the profit of ESCO. I need to properly present them. So since I didn't buy the whole of the shares of ESCO, I can't cancel out everything. For instance, anyone you did not cancel out, you call it non-controlling interest, which is why I'm calling it that. And in the process of cancellation, I need to bring this up also to 100%. So I'm comparing 100 against this 100% here because this is the old shares. And that's why when I want to cancel out, I introduce NCI here. And that's how we continue to do it. So you get used to it. So this is 0. Then, since NCI is not cancelled, is 5,000 from what I've gotten here. I can simply pick the value here. Then he shares in the retained earnings of the subsidiary. Then we get the balance. That's all I've done. Then I consolidate. So PP, I added the parent and the subsidiary together. Current assets, same. Share capital. This is just the parent alone. Okay, because that of the subsidiary have been cancelled out. The balance is now NCI. Then retained earnings for my workings, 16,250. I already worked it out. Then NCI for my workings. This is the balance of the share capital of the subsidiary as well as their share in the subsidiaries retained earnings for my workings. Then current liabilities, the addition of the parent and the subsidiary. And that is that. Any questions? Okay. So the
Sir,
next, yeah,
sorry, sir.
yeah,
Please,
Lima.
I really don't understand. Please go up behind this from this number two workings. I don't understand.
Okay, you need to tell me exactly what you don't understand though.
Okay, when you said this NCI, the value of NCI, the 5,000, then the share of the retained earnings of ESCO, this 25% of, is this 25% of this 5,000 from the NCI?
No, 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 no. Thank God you mentioned it. Okay, it's not of the NCI, it's of retained earnings of ESCO. This 5,000. This
Okay.
5,000. It's just a coincidence so that this one too is 5,000. This 5,000 here is just the value of NCI. This one is a different 5,000 entirely. Yeah, very good question, Alimat. A lot of people will have just assumed, but maybe you understand it later, Sha, when we do more examples, that we are not taking 25% of this, we are taking 25% of the retained earnings of ESCO, because NCI also have a share in that, it is also an owner in ESCO. It's also an
Sir,
owner in
can you go down, please? Like, can you continue? This 25% of this consolidated retains earnings of PICO that is 12.5. Please, I don't understand.
Yeah, okay. It's this one. Have you seen it?
Yes, sir. Yes, sir.
Okay. So he also gets 75% of that 5,000 too. And the 5,000 is the retained earnings of ESCO. Any other questions before we move forward? This is the first time I'm hearing Alima's voice. Alima's therefore finds only group important. No, it's even the least important self. David,
Sorry, sir,
go
can you
ahead.
scroll to the consolidated statement, sir?
Okay. Yeah, this is it.
Okay, why is NCI represented under equity in the parent, like in consolidated book?
Yeah, that's a fantastic question. So, because he's also an owner in ESCO, and IFRS 10 requires that we should see NCI as part of the group. We should see NCI as part of the group. That's why we're putting, because NCI is not a liability. So it's either we are putting it as liability or equity. If you put it as liability, it means that we are saying we owe him. We owe him that amount, but it's not like we owe him. He's a part owner of ESCO. So which is why it's coming as equity in the group. It's a part owner of ESCO. Good question. Did I answer your question, David?
Thank you.
Okay. I'm actually waiting for more questions from the way I'm teaching you. Okay, let's move further then. Now, we have goodwill and pre-acquisition retained earnings. It says here, Pico acquired the ordinary shares of ESCO on June 2017, when the statement of financial position of each company were as follows. So they give a statement of financial position of the two companies as at June, parent and subsidiary, and I'm asked to consolidate. Okay. So can any one of you tell me the similar items here that we're going to cancel out in Pico and ESCO? You can tell me the items that I will cancel out here.
Let me try, sir.
Ordinary share.
Yeah, the ordinary shares is going to cancel out as the 25,000 ordinary shares is going to cancel out,
Against
and against 25,000 of ESCO is going to cancel out. Then
no, wait, I
the
don't
remaining.
get. Let's start with Pico. What's canceling out in Pico?
Okay. So from what I'm seeing, I think he has paid a higher amount than the net asset of ESCO. So we are going to cancel out 25,000, and the remaining one is going to be, which is going to be Goodwill, something Goodwill. Yeah, since he's paying above the net asset of ESCO, so he's paying probably for the brand name or patent or something like that. So he's going to go to Goodwill.
Okay. Fantastic. I saw your hand up. Shidera, why did you put it down?
So that's to say.
Okay, that's what you wanted to say. Okay. Very fantastic, Michael. So yeah, this 40,000 is cancelled out against this 25,000. Why did you omit this 5,000, Michael? And Shidera, because Shidera said that is what she wanted to say too. Are you saying we won't cancel out this 5,000?
I wanted to speak into the investment in associate Pico and the ordinary shares, not the retained earning.
Yeah, speak to that. Okay, Shaya, I can see your hand. Please.
Yeah. So from what we've been looking at, so in my understanding, we should take that out because it is not from inception that the acquisition happened. So it means that 40,000 naira Pico paid is has covered the retained earning. So that's my understanding. So it should be part of what we will cancel.
Nice one, Shaya. Okay, about case.
I agree with Sheye because the statement of financial position is as at 30th of June, 30th of June, which is the same period that Pico acquired ESCO. So the full 30,000 in the equity capital of ESCO would be cancelled out from the 40,000 naira investments in ordinary shares. So the remaining can go to Goodwill.
Fantastic. Fantastic. Very good. Very good. That's absolutely correct. So Michael, that's another one you need to note. Probably you know it before. So this 40,000 here has to cancel out against the entire 30,000 because look at when we acquired ESCO. Look at when this account is prepared. So that means this 40,000 actually relates to both the share capital and all the reserves of ESCO because they were there. It's there at the date of acquisition. Any reserve that is there at the date of acquisition will be cancelled out, which is what you guys call pre-acquisition reserve. Which is what you call pre-acquisition reserve. Is that okay? So, and that is all. And I can hear a lot of you talking about goodwill. You're perfectly right. I think Michael also mentioned it. You're perfectly correct. So, and why that is coming up is because we acquired 100% in ESCO. We acquired all the shares in ESCO, all the 25,000 shares. This is how I know. All the 25,000 shares. And ESCO has 25,000 shares. We acquired everything. But the value of those shares, the equity or the net asset is 30,000, but we paid 40. We paid above it. And that's goodwill. That's goodwill that we are paying for. There's something we can't see, but we believe is not a tangible asset, but we believe it has a value, and we decided to pay for it. And it's goodwill. So you're absolutely correct. That's why I labeled it goodwill. So I canceled out this 40,000 against the equity of ESCO, which comprises the share capital and the pre-acquisition retained earnings of ESCO. So which is 30, the balance is goodwill. That will be consolidated. That will be consolidated. And that's the only item you cancel out. Every other item, these current assets, you add it together, along with the goodwill, the balance of 10,000 here, consolidates. The share capital of the parent, you'd consolidate. Then the retained earnings, this 5,000 has been cancelled out because is the same transaction with this 40K. Then we only consolidate this 22.5. And that's what we did here. And that's what we did here. That's what we did here. Okay. So let me allow you guys go and rest. When we come back, we would move faster. So I just wanted to get to this point to see goodwill. Every other thing is just repetition. We will be building on that. The principle still remains the same. Cancellation. We are canceling out similar items. So if we are seeing that what we are canceling out, there are some things that are out of balance, we'll explain the reason. And hopefully we'll be able to finish all the questions on statement of financial position where we come back, including other intra-group transactions, so that next week we'll just focus on associates and P&L. Then we'll be done with group account. Then I can then go to advanced part for you, for the other guys, while we move to other important areas of our syllabus. But we need to get over with this guy next week, worst case. So I will advise you, we are coming back by, let's come back by 9. Today is Sunday, right? Yeah. Let's come back by 9 because of the Muslims so that they can pray, break their fasts. Let's settle. Let's just give additional 30 minutes. 9 will start. So we'll do what we have to do. 1.5 hours will be done. Then we'll continue from the next class. So you can go and revise all of these that I've mentioned while before we come back so that we'll be faster when we return. Thank you. I would see you guys later. Bye.